Welcome back to the Value Investors Club. I'm your host, Timo Wunderlich. Let's get right into it with VIC ratings, the format where we look at the best of the best value investment recommendations by the best of the best value investors out there. Today we have Warner Bros. Discovery Inc., ticker is WBD, price at the point of filing is $14.22. I'm really excited for this one. I was invested into WBD for some time and actually gotten out, which might have been a mistake. Let's see. Long Warner Brothers Discovery WBD paired with short Paramount. Para. Thesis. As WBD pivots from a year of restructuring to one of execution, I think WBD will narrow its current valuation spread relative to Para. Both are close peers making the transition to streaming with their linear video business, accounting for a majority of EBITDA. See Exhibit 1. Secularly pressured by deteriorating cord-cutting trends and ad environment. However, WBD and Para stand in stark contrast with each other in terms of growth profile and direction of estimate revisions. Execution on synergies will drive EBITDA and FCF growth for a WBD from here, even in a worse macro, which differentiates it from Para, which has decline in EBITDA and continues to burn meaningful FCF this year, before hopefully inflecting to positive FCF only in 24. WBD trades at a current 3x turn a discount to Para on NTM EBITDA, which I believe will narrow 2x turns in the near term, with a potential for complete elimination of the discount given the similarity of the business and long-term prospective growth algorithms. WBD and Para trade at 7.5x and 11.1x 23 EBITDA and 6.8x to 9.2x 24 EBITDA. If WBD re-rates to Para, there's a 90% upside to the stock. On FCF, WBD is too cheap relative to Para at a 25x turn discount on 24 FCF. WBD at 7x, Para at 30x, and there is a further upside should WBD re-rate closer to Para on the spaces. Price target. I believe WBD can narrow its current valuation spread versus Para. WBD trades at a 3x turn NTM EBITDA discount to WBD. And each 1x turn on WBD is worth 30% to WBD's stock. WBD is trading only at 0.5x turns from the wides versus Para, setting up an attractive R/R of 2 to 3 turns of 2 to 3x turns of tightening versus 0.5x turns of widening. See Appendix 2 for a relative valuation chart. Situation overview. WBD was formed in April 2022 when AT&T unwounded their 2018 acquisition of Time Warner by spinning off the asset and merging it into Discovery. WBD is in its transition to streaming against the backdrop of ongoing secular pressures in linear video from a challenging and an environment and deteriorating cord-cutting trends. In the past year, WBD was also impacted negatively from inherited, unexpectedly worse assets from the merger, setting back some restructuring efforts. Moving forward, WBD will continue executing on synergy targets, targeting $4 billion plus through 24. While meaningfully delivering their balance sheet from 5x and 22, WBD will be relaunching their DTC product that will combine HBO Max and Discovery Plus in the US market mid-April and roll it out to the international markets through 24. Why the opportunity exists. Over the course of 22, media stocks were hit hard given macro and secular pressures, with most having gone through significant multiple contraction. However, Para actually saw meaningful multiple expansion versus peers given the sheer magnitude of their 23 estimates being cut. EBITDA cut by 45%, FCF flipping from 1 billion plus to 100 million minus in the same period. Minus 100 million, I'm sorry. Moreover, WBD multiples also faced significant idiosyncratic pressure over 22 when one T management, AT&T, surprised the market with how the mechanics of the merger would be executed. Market expected an exchange offer. Instead, we got a spin-off, which induced a technical selling pressure from legacy T shareholders. 2. Estimates revised down from management projections filed in an minus $4 given harsher macroeconomics conditions that played out over the course of 18 months since the deal was announced. And three, WBD inheriting unexpectedly worse assets from the merger, setting back some restructuring efforts. On FCF, WBD is too cheap relative to Para at 7x, 24 FCF versus Para at 30x. WBD will grow EBITDA 20% x plus in 23 with FCF conversion of 33 to 50%, guiding to 60% long term. While Para will see EBITDA down 20% plus and burn FCF to the tune of minus 800 million, including 300 million of restructuring costs, before growing EBITDA again and inflecting back to positive FCF in 24. The discrepancy in FCF profile is stark as Para had been lagging peers in their transition to DTC and had to invest aggressively to catch up, with elevated cash content spend pressuring FCF conversion and will see peak DTC losses in 23. On the other hand, WBD FCF is supported by moderating cash content spend and synergy realization. Even as I look past near-term timing differences in the DTC ramp, I believe part of why WBD FCF conversion is superior to Para is due to a higher mix of unscripted content from legacy Disca. Before the transition to DTC and normalized the for M&A, legacy Disca FCF conversion was 55% plus, while Para was weaker at 40%. The difference in direction of estimate revisions also makes the pair more compelling. FY23 guidance turned out to be fine for WBD on the Q4 print, with Street FY23 EBITDA/FCF unchanged for the most part. Moving forward, WBD likely will see positive estimate revisions through the year as they are likely to surprise to the upside on their synergy execution, while Hogwarts Legacy/The Last of Us outperformance are also tailwinds to financial results. On the other hand, Para has just cut 23 FCF meaningfully and only expect to see FCF inflect back to positive in 24, essentially kicking the can down the road such that estimate revisions are likely more range bound until I get more clarity closer to the end of 23. Risks. M&A risk. WBD and Para are both viable takeout candidates in an industry that will see further consolidation. I think it is unlikely anything is happening in the near term and under the current regulatory regime. However, if either were to be taken out for the sake of argument over a 3-year timeframe, I would argue that WBD is more attractive takeout candidate over Para. In mid-24, WBD will lap the 2-year moratorium against M&A per RMT tax avoidance rules and be in a better position to be acquired. CMC-SA would have been a likely acquirer of Warner Media back in 22 if not for the regulatory risk. T recognized in doing a deal with CMC-SA. A transaction with Para, on the other hand, is more compelling given their broadcast exposure, which limits the buyer pool and introduces additional regulatory challenges should potential divestitures be required. High financial leverage. 5x creates a wide range of outcomes depending on how EBITDA holds up given worsening cord cutting and advertising trends. Both WBD and Para are consensus short. Per Bloomberg, WBD has 3% short interest slash 3x days to recover. To cover, Para has 90% short interest slash 6x days to cover. So there's a squeeze risk. Catalyst. Achieving deal synergies target with quarterly earnings and validating successful execution. Consistent deleveraging of balance sheet with net leverage going down from 5x in 22 to below 4x by year end 23 and expected to hit 2.5 to 3x gross leverage by 24. Consistent deleveraging of I just read that. I'm sorry. Hogwarts Legacy headlines and upside to financial results. DTC relaunch mid-April, along with further cost containment and OPEX cuts to DTC. Accretive asset sales that will accelerate deleveraging path. Thank you very much for tuning in. See you next time. Please write down in the comments below what you think of this